You think the Supreme Court just saved global trade by striking down the presidential tariffs? But Washington just triggered a universal margin tax that is going to aggressively drain your portfolio's cash flow. Today, we are tracking the massive collision between the new statutory global tariffs and the artificial intelligence infrastructure boom. We will follow how the strict border chaos drains cyclical working capital, while technology giants use artificial intelligence to permanently expand their software margins. Stick around to see exactly why the Federal Reserve might pause interest rate cuts even if technology productivity skyrockets. The Supreme Court invalidated the emergency tariff powers on Friday, sparking a massive relief rally illusion. But reality hit at midnight on February 24th, with a brand new statutory 150-day tariff window. And this isn't just a targeted strike. It is a 10% margin tax applied to imported articles from every single country. And the White House is already threatening to push that rate to 15%. If you own supply chain-dependent cyclical companies, your investments are bleeding. They only have a brutal 96-hour window to clear goods that were already on the water before the deadline. It is not a grace period for new orders. To make it worse, companies using foreign trade zones are now legally forced into privileged foreign status, locking in those high duty rates immediately. That is pure free cash flow being burned at the border instead of being returned to you as shareholder dividends. The Richmond Fed Manufacturing Index dropped to -10 today, proving the physical economy is already absorbing these elevated input costs. Capital is fleeing that physical border chaos and aggressively hiding in the cloud. The Nasdaq 100 jumped over 1% today because Anthropic just fundamentally changed the software earnings path. By launching enterprise plugins with partners like DocuSign, FactSet, and Slack, and connecting to Google Calendar, Anthropic proved that artificial intelligence is a complementary margin booster. Concurrently, Intuit announced a separate massive partnership to build customized artificial intelligence agents on Anthropic's platform. Software companies can now raise subscription prices for premium tools while slashing their own internal operating expenses. That creates an unencumbered cash flow stream that completely bypasses customs agents and supply chain bottlenecks. But the hardware side of your portfolio is ruthlessly divided based on who is actually funding the capital expenditures. Advanced Micro Devices spiked 9% today after securing a massive multi-year contract for Meta's 6-gigawatt artificial intelligence data center. The market loves this because AMD gets highly visible, high-margin cash flow funded by Meta's incredibly deep pockets. On the flip side, Texas Instruments dropped sharply because investors are terrified of their broad-based fabrication plant expenditures. In this current market, if your capital spending is not explicitly tied to a mega-cap technology build-out, institutional investors view your spending as a toxic liquidity drain. All of this fundamentally alters the Federal Reserve's math and the cost of capital. The 10-year Treasury yield is glued above 4% because of a critical dilemma at the central bank. Governor Lisa Cook warned that artificial intelligence could raise productivity but also drive unemployment, leaving the Fed stuck between fighting inflation and boosting jobs. Chicago Fed President Austin Goolsbee warned against relying on productivity hopes to solve inflation. Meanwhile, Governor Christopher Waller just noted that if the labor market continues to show a solid footing, he might tilt toward pausing interest rate cuts entirely in March. This means money stays expensive. Your portfolio's technology winners can absorb a 4% discount rate with their rapidly expanding margins. But the cyclical industrial companies getting crushed by the new tariff costs cannot afford this expensive debt. Tomorrow is all about confirmation. Watch NVIDIA's earnings after the bell on Wednesday to see if this massive infrastructure spending is translating into actual gross margin expansion, and keep watching that 10-year yield. This isn't financial advice. It's just the math the anchors wouldn't do for you. Keep your eyes on the margins. I'm Wilson, and I'll see you tomorrow.